Hello, everyone. My name is Almas, and welcome to the very first episode of Nomad Capital podcast. A little bit about myself. I started my investing journey around 4 years ago. Along the way, I made plenty of mistakes when choosing companies to invest in, but every mistake was a lesson and opportunity. That's what led me here on this podcast. Here, I will be interviewing people who are also passionate about the world of finance. In each episode, my guest and I will take a deep dive into at least one publicly traded company and discuss their investment approach and strategy. Today, I am excited to be joined by my friend Henry, whom I met on Twitter or nowadays X.com. We'll be talking about a company called Upstart. Henry is one of the sharpest minds I came across when it comes to understanding Upstart. He arguably knows more about it than most Wall Street analysts. I first discovered his account while doing my due diligence on another company called Fair Isaac Corporation. And after reading his insight on Upstart, I became genuinely interested. That eventually led me to dig deeper into the company and ultimately invest in the company myself. Henry also runs a small Twitter group focused entirely on Upstart. If you are interested in a company, you are welcome to check it out and join the conversation. Before we start, just a quick disclaimer, nothing discussed in this podcast is financial advice. The purpose of this podcast is only for entertainment and educational purposes. So without further ado, let's get into it.
Okay, so hello everyone. Today I wanted to interview a great friend of mine, Henry. The Henry is the original author of the Upstart thesis that I borrowed and started looking more deeply into the Upstart. So yeah, Henry, thanks for joining me. Can you spend a few minutes to talk about yourself? What are you doing for a
Mm.
living? Where do you study? What's your interests are?
Yeah, well, thanks for having me. Excited to be here and congrats on the podcast launch.
Thank you.
A little bit about me. I'm Henry. Henry Invests on X, and I've really been studying the market for a little over 3 years now, but really intensely. It's kind of like my full-time job, even though it's not paying just yet. I'm a college student finishing up the last year of my undergrad, majoring in finance. Not exactly sure what I want to do with that just yet. You'd think equity, like management, portfolio management, that kind of thing, but still up in the air, thinking maybe there's different areas of finance I can do, like kind of financial journalism is what I'm doing right now and what a lot of people know me for on X or Twitter. And I'm spending a lot of time covering a company called Upstart, which is something that I started in 2023, really, and has just sort of kind of like taken over a lot of my time as the company's progressed and we've seen a lot of the developments, stock price has risen a little bit and sentiment's gotten a lot better. But yeah, so I'm really just a hyper focused, concentrated growth investor in a couple of select names that I spend a lot of time talking about online. And I try and mitigate the risk of those with different options, strategies, and things like that. And I post all of my returns and all of my trades really on this hedge fund that I'm running called Maple Tree Capital. And the goal with that really is just to provide a performance track record and
Mhm.
people can see my moves. And also, if I'm talking about something online a lot, people can see, well, hey, he's actually, invested in this and this is his exposure. Not trying to be a charlatan, just trying to put it all out there so everybody knows what I'm actually doing.
Sounds great, thank you. And I'm really curious, as a graduate, how did you started the investing? Because in my case, I only started investing when I started doing my full-time job. I started getting the retirement matching, and I was like, well, I can put it into the bonds or I can put it into the things called the stock market. And at that time, I was 24 and I didn't know anything about the stock market. So it was kind of, everything was really new to me. And you started as a college student. I'm really curious to hear how did you come up with this idea?
Yeah, sure. I really started kind of at the back end of high school. COVID happens and everybody gets locked down into their
Mhm.
house. Lots of new interests to sort of look at. And I like to think of my journey as an investor as pretty relatable to everybody's journey,
Mhm.
simply because when I had started with the stock market, I had no formal background. I knew literally nothing. And I went through the progression that every single new investor goes through. And the timeline which I did it was also really crazy. I turned 18 in November of 2021. if you look at, so I have my, that's when I opened my own brokerage account. If you look at where the market topped out in 2021, it was in
Yeah.
November. So I start investing at the exact top, and I don't know anything about, I don't even know what the Fed is at this point, right?
Hmm.
So we go from peak euphoria on growth stocks in 2021 when I just start to be able to participate to like peak depression in 2022 when the Fed
Hmm.
raised rates so high and all these growth stocks got crushed. So those 2 years, I had no idea what I was doing. And
Hmm.
eventually I was like, okay, it was maybe like midway through 2022 is like, this is not working. Like I'm just wasting my money. I'm listening to other people online. Like I did the whole YouTube thing where listening to YouTubers, what stocks are they in? Oh, well, that sounds good, right? All that kind of stuff.
Hmm.
And about halfway through 2022, I was just like, this is not going to work. If I'm going to actually want to do this, like I have to build my own process. I have to understand all these things by myself, and I can't rely on other people to tell me what I need to do. So I spent a lot of time reading, learning about the Fed, and really deepening my education. And then in 2023, I launched Maple Tree Capital, really not
Hmm.
knowing exactly what I was doing, but wanting to like push myself to document my journey and really hold myself accountable for what I was doing. So through 2023, I continued to learn more about investing, read a lot
Hmm.
of books, started then looking at this portion of growth investing, misunderstood growth investing, which is how I found really Upstart. And so then I did that for a while throughout 2023. And then in 2024 was really like I kind of turned the chapter, started gaining a little bit more recognition, started publishing public shareholder letters for Maple Tree Capital versus just like in-house reviews. And 2024 was a great year of growth for me, and we started off strong in 2025, and then Liberation Day and the tariffs happen and a
Oh,
little
yeah.
turmoil in the markets, and so we've taken a step back, but it's been a great learning experience, and I think my journey is pretty relatable, just going from not knowing anything to slowly building up my knowledge.
Uh, when I started, I was so afraid of market because the only thing I knew is this movie Wolf from Wall Street.
Yeah.
And my impression was that everything in the stock market is a fake and people are trying to steal my money. So that's why when I joined, the only thing I was invested in is the Canadian banks. So in
Yeah.
Canada, we have this thing called Big Six, the six biggest Canadian banks. I'm pretty much sure the banking system in Canada works a bit differently than US because I heard in US you have like 1,000 banks, 1,000 regional banks, but in Canada it's just Big Six, nothing more. There are two smaller players, and most of them are getting being acquired by the Big Six. So no growth,
Yeah.
5% dividend yield, but at least I got some money every quarter in my brokerage
Hmm.
account. But yeah, I figured out while I'm young, it's that it doesn't worth it. I'm curious that so you are studying the remind me, you are studying the not the market, the finance, right?
Yeah. Hmm.
Does it help you with the investing or it's completely different field?
Yeah. So it's a really good question and one that I've been thinking about a lot. So I would say there's different types of investing.
Mm-hmm.
Like my undergrad right now is teaching me the disciplines that you need to like project cash flows, run a discounted
Mm-hmm.
cash flow model, property equity valuation analysis, reading 10Ks, that sort of stuff. So in the traditional sense, it's giving me the financial background that I need. But really, a lot of my self-learning hasn't been focused on that part of investing.
Mm-hmm.
It's really been focused on the mindset, the psychology, the emotions behind investing, what drives action, what drives people to do like behavioral economics, sort of that kind of thing.
Mm-hmm.
And then also like following a story and following a narrative. So I think for finance, everybody thinks you have to be super good at math and all this different stuff to be able to properly evaluate a security. But really my view on it is for people who can understand a story behind something and just have a decent grasp on the financials can really get a better edge than somebody who's only looking at the financials trying to predict what those say when in reality I think a lot of the alpha or a lot of the gains can come from understanding what the team is communicating with you, what the perception is versus the reality, and so you
Mm-hmm.
can get a lot of extra information like for Upstart and some of the other companies that I follow like Lemonade and even Grinder. I've probably listened to every single interview from the CEO, from the CFO, all of that. And that's not even to say if the interview is like about their company. Sometimes
Mm-hmm.
these executives will do just like a chat on a podcast and they don't even talk about their company, but you get to learn more about them and their psyche and how they make decisions. And I think that's very important. And so I would say, getting back to your question, like when I'm thinking about what my undergrad has taught me and a
Hmm.
lot of the skills that I'm applying, they overlap, but they're also in two very different camps. So I think the good news for, and wannabe investors, like I would say a lot of the information that I've learned, I didn't need
Hmm.
to go to college for. So I think it's definitely something that's achievable for intelligent, disciplined people in other disciplines like science or whatever it is, medicine, who then just want to study on their own and see if they can do well in the markets. I think you can probably do that really, really well.
Hmm. And one of the follow-up questions I had in mind, so some of my friends are too hesitant to invest in the market because what they're telling me without knowing anything, there are like these big banks like JP Morgan and all the other stuff where people are running, as you said, discount cash flow models, and they probably already priced in everything, every moves in the market based on the every conference call, all the information that management are sharing. So would you say that the everything is already priced in the market and there's no alpha? Or
Sure.
I know that the stocks are really volatile, but why it happened when everything is already priced in? And do you believe in this theory of the efficient market?
Yeah, so I say I believe in 90% of the efficient market hypothesis. I don't
Hmm.
think the market is entirely efficient. I think it's largely efficient,
Hmm.
always the way that I frame it. But, and I'm sure we'll talk about it later, but I just want to say, like, as somebody who just went to an investor event and you look at all of these analysts,
Hmm.
you think because they work for a big bank,
Yep.
they
Yep.
know everything. It's not true. And I know it's not true because I saw it with my own eyes as somebody who's done the homework on the stocks. So I think a lot of times Wall Street, right? Like Apple, Amazon, Fane,
Hmm.
all of these big companies, there is no alpha. There's
Hmm.
none because these guys have been following it. They are embedded with the management teams. But here's where I think there's a difference. If you start with a small cap company,
Hmm.
say like under 5 billion, right? Yes, there are analysts that follow that, but also you'll see for a lot of these companies, there's a very dedicated, strong retail investor base. So
Yep.
SoFi, Upstart, Lemonade, Rocket Lab, ASTS, Space Mobile. I'm sure there are many other hymns, right? There's many others that I'm missing. And even Tesla started with a very
Hmm.
small community. And what happens is retail often spends a disproportionate amount of time studying and understanding these companies. Robinhood, Palantir, those are two more.
Yep.
Understanding these companies because it's not worth Wall Street's attention because they're too small, they're misunderstood. And so retail spends all this time when these learning about them when they're small. And then as these companies grow and as they get bigger, the knowledge advantage that you have compounds because you already understand every vertical of the business prior to whatever the business is launching now. So for Upstart, right now they're going into all this prime products. And if you're on the outside looking in, it's going to be a lot harder, and you're just starting to analyze the company. It's going to be a lot harder for you to understand how that impacts the entire company than if you had had a really strong grasp and understanding of the company throughout, the past couple of years before they launched into this
Hmm.
new expansion, because you would see the synergies, why they're doing it, what it thinks they think it means for the business. So I think over time, retail gets a huge knowledge advantage by just being early on a lot of these companies, and
Hmm.
also in a general blanket statement for smaller companies, Wall Street doesn't have the same amount of time to cover them. Like you have
Hmm.
whole communities that are like 100 plus people spending several hours a day of mental energy trying to understand something. That's very like that's extremely powerful. These Wall Street analysts, even if they work in teams, like they're covering so many companies because they have all these rules, they can't
Hmm.
dedicate that much time to a specific company every single day. And so I think, that's why I believe the market is largely efficient, but not
Hmm.
entirely efficient.
I remember a few years ago, I've been watching this series called Billionaire. Not sure if you've seen it.
Mm, okay.
Uh,
Yeah.
yeah, and there was an episode when like this hedge fund wanted to invest in the manufacturer, and what they did, they were using the proprietary data from satellite to see how the new factory is progressing, and based on this information, they decided whether they want to invest in this stock. And I was like, wow, probably those people in Wall Street, they have all the information they need comparing with retail investor, where we can just read the financials, we can just take a look at the history of the management. But even then, as you said, for these small caps, the retail investors still have an advantage because they have the small communities, the community of Upstart that you started. We will talk about it later, where people are sharing so much information that they can't find anywhere online, especially in Bloomberg videos. So yeah,
Hmm.
thanks for sharing it. Yeah, I guess before we go into the Upstart, I wanted to talk a little bit about your hobbies outside of your work. So I know you are doing some small businesses, so if you can like share some information about it.
Yeah, for sure. So I guess also going back, just rewinding to COVID quick, before I
Mm-hmm.
got interested in the stock market too, like the
Yeah.
collectible space really blew up. And so think of sports cards and Pokemon cards and that, with interest rates at near zero and people stuck in their homes with all the nostalgia,
Mm-hmm.
that industry took off like crazy. And so I rode that wave, which was really nice because it helped, I guess cover some of what happened in 2022 when the liquidity scene got reversed. But yeah,
Mm-hmm.
so that's I had some experience, a lot of experience with collectibles and sort of that thing post COVID. And really, right now, I was looking for something to do before I started, work. And I'm doing this Upstart thing, which is a lot of fun, but I had a little bit more time, so I started a Pokemon card business
Mm-hmm.
called Snorlax Slabs, and it's really very interesting. So the only reason I started is because I'm leveraging my previous collectible experience, and I think that's valuable. There's a lot of things you may not know if you're just starting out. So I was just really revisiting a business that I already done, and what I noticed is something going on with GameStop.
Mm-hmm.
I'm just sitting on my phone, and GameStop all of a sudden flashes a notification. It's like, oh, you can grade your cards now with PSA through GameStop. And so maybe for people that just don't know even know what I'm talking about right now, if you have a collectible card, right, a
Mm-hmm.
Pokemon card, based on its you can get it graded. The
Mm-hmm.
top company that does that and provides the most value is PSA, Professional Sports Authenticator.
Okay.
And if you get a good grade, known as the PSA 10, a
Mm-hmm.
$20 card can turn into $400.
Mm-hmm.
And so in 2021, when the first boom happened, if you wanted to grade a card, you had to fill out the paperwork yourself. You had to package all these cards yourself because you have to ship them off to
Oh.
PSA, who's in California. So for
Mm-hmm.
anybody that's not in California, you've got to fill out this lengthy paperwork. Then you've got to ship the card yourself. You got to make sure it gets there, all this different stuff.
Mm-hmm.
So, really, in January or December of last year, so December of 2024, I'm learning about this GameStop thing, and I realized you can literally just take your cards in, drop them off at GameStop, and GameStop will send them out for you. They'll do the paperwork, they'll insure the package, and then you can just pick it up and you can track it all in the app. And I'm like, oh my goodness, this is like revolutionary as
Mm-hmm.
somebody who had previously had to do the bad experience. So I got my brother and I was like, look, man, like we have to attack this right now. So we went out to all these trade shows on the weekends and we bought so many cards, looking at them to see if they're in good condition. And then
Mm-hmm.
we sent them all through PSA or through GameStop to PSA. And the grading price to do that, so the price per card was like, I don't know, maybe $15 when we first started in January.
Okay.
Now it's up to like $19, I think. So they
Wow.
slowly, yeah, they've realized they're mispricing and they got a ton
Mm-hmm.
of demand. And during that time, too, since GameStop provided all of that accessibility, which was a part of the thesis, the price of the graded cards went up because there was more pent up interest and
Mm-hmm.
everybody started to get into a euphoria about grading their cards. And, that's sort of faded really since the market kind of pummeled in I guess April, but prices have come down a little bit. But that was an insane hype wave that I took advantage of on Pokemon just because there was like a fundamental difference in the process of grading a card. And so those are opportunities I look for, in the market and outside of the market. If there's something new and people don't understand it, I found that very often you'll have like a really short window to act on something. I think the GameStop loophole, if you want to call it that, is probably dead now. Like everybody's caught on to it, but it was really nice for about 2-3 months.
So, sorry, maybe I'm a little bit confused. So
Oh,
your
you're good.
business was you are going through these shows and you are picking up all the cards you have, ungraded cards, and then you send them to GameStop. And if you see that the after grading the price goes up, you then go to another show and show like, hey, now I have the certification that it's an official card. Do you want to buy this card for like $400?
Yes, exactly. So I'll go. I would go to all these shows, and
Mm-hmm.
I had experience grading in the past. So if you have think of it as like a trained eye and an untrained eye, you know what you're looking for. So
Mm-hmm.
you can find a lot of good cards that are grade worthy. So I would just go to all these shows, look at these cards, say, okay, this is a Pikachu in great
Mm-hmm.
condition.
Yeah.
I think it's going to be a PSA 10. They're asking $40 on it. Okay,
Mm-hmm.
great. Here you go. I'll buy that, right? Then I'll drop it off at GameStop that day. I'll pay the $15 it was at the time to grade it. So now I've
Mm-hmm.
got $55 in the card total.
Mm-hmm.
And if it comes back a PSA 10 from GameStop, it's worth, 150, 200 bucks.
Mm-hmm.
And so that's what I would do. And it was really great. My hit rate, meaning the percentage of cards that I sent in to PSA that got the highest grade, was like 50 or is like 55, 60%, which is really, really good. So that's over half the cards were getting tens. And so, yeah, no, that was a really nice business model with games. You couldn't do it without GameStop. GameStop opened it up
Mm-hmm.
really at scale. And so that was really nice. But, in March, people really started to catch on to that.
Mm-hmm.
And then the price went up at GameStop. There was more supply on the market. And so prices started to come down in some cases a lot.
Mm-hmm.
So it was a nice little wave, and I'm still doing it, although not as much as I was. But it's just one of those things where it's like, look, like you can just find opportunity
Yeah.
everywhere. Literally found opportunity on my phone from a GameStop notification, and you just gotta be willing to act on it. And I think the other thing too is like you can't really be afraid
Mm-hmm.
to do it. If you're gonna do it, like I'm all in. And so that was my mentality on it. I wasn't gonna like half do it. So made some mistakes along the way too, but it was fun. Yeah, I like it.
In terms of the timeline, was it the same time started his podcast about the GameStop, or it was like earlier or later?
Yeah. It was after that. Yeah, it was
Or
after that. Because GameStop now too, GameStop's actually a really interesting stock now that they've bought Bitcoin. And I think,
mm-hmm.
right, it's a legacy business is in decline. Nobody's arguing against that. But actually what they're doing with collectibles, like the PSA partnership I just talked about, their heavy cash pile, and they're gonna be able to pay down all of their debt. Like it's an interesting play at the right price. I almost bought it a couple of months ago and I sort of missed out now. It's up pretty significantly. I wrote an article about
Mm-hmm.
the exact thesis that I have right now, and I think it's interesting. We'll see what they can do, but there's definitely like a cult fan base around GameStop.
Interesting. The last question about GameStop. So this certification, does it only work for the Pokemon cards or any other like sport
No,
cards
yeah,
or?
you can do sports cards, and I think
Mm-hmm.
One Piece cards and maybe
Mm-hmm.
Yu-Gi-Oh too. Sports cards to grade them is a couple dollars more a card,
Mm-hmm.
just because they tend to have higher value. But yeah, you can do any different really card that you want at GameStop, and you can still do that today. By the way, the price is
Mm-hmm.
a little bit higher, and since so many people have been sending cards in, you may have to wait a little bit longer to get them
Mm-hmm.
back. But you can still do that today.
Interesting. If
Yeah,
you can grade any card, the total addressable market is a lot higher than I initially thought.
yeah,
Uh,
no, it's and the thing with these is like with slabs, you call it a slab if you get something graded back.
mm-hmm.
Like there's so many different price ranges, like I can have a $50 slab and I can have one that's worth $500. So even though they're graded, like the amount of people that you can sell them to is so high. And also like I guess I have one right next to me, so I'll see if I can just show the camera. Maybe I have to unblur myself, but like you can sell them to basically anybody and they come really nice and
Mm-hmm.
protected. So it's like here.
Oh, okay, yeah. I have a bunch of them. Probably I
Yeah.
need to yeah, send them to GameStop.
Yeah, no, you should send them to GameStop. So like let's see if I can find another one quickly.
Mm-hmm.
This one is the holy grail. Like this is how I was like, okay, this is great. So this is a bubble Mew
Mm-hmm.
PSA 10. I bought this card for $300 cash,
Mm-hmm.
graded it for the 15. Now there's an upcharge, meaning if the card is worth so much money, like in
Mm-hmm.
this case, I think over $700,
Mm-hmm.
then they charge you a little bit extra. So I paid like $80 to grade it with the
Mm-hmm.
upcharge, paid $300 for it. It got a 10 and it's worth like $750. It was worth 1,000 at one point, and I probably should have sold it, but I didn't. But
It's
that's like,
interesting.
yeah.
Sorry, it's interesting because I saw the collectibles price depend on the demand and supply. But you're saying that once you have this PSA grading, the price is fixed, right? Whatever the demand in the market is, the price will always
Well,
be like $700.
so like the Mew that I just showed, right? Like it
Mm-hmm.
was worth 1,000 in
Mm-hmm.
February. Now it's
Yeah.
worth 700. So like the prices will change, but
Mm-hmm.
depending on what you buy the card for, and then
Mm-hmm.
assuming it gets a PSA 10, normally the step up in value with the
Mm-hmm.
PSA 10 certification is enough to like make you in the green. But the prices can bounce around. And then the other thing with that though is like, I'm making it seem a little too easy. Like getting a PSA 10 is like really hard.
Mm-hmm.
So you have to have experience grading cards and you have to know what to look for. And I get back like I have a stack next to me of cards that got like PSA 8s and PSA 7s, and those are cards that I actually lose money on
Mm-hmm.
because I graded them and then they graded really really bad. So you can lose money doing it too, but normally your wins, if you do it right, outpay your losers.
Mm-hmm. Interesting. Yeah, I will definitely. Next thing in my to-do list, I will send all my cards into the GameStop and see maybe I can earn some extra money.
Yeah. Well, and GameStop will now buy your cards too. So that was initially part of the thesis. Didn't
Mm-hmm.
pan out just because the market took off so quick, but GameStop will give you like cash offers on
Mm-hmm.
any graded card. Normally they're like 60% of market. So it depends how much you want the money, but
Mm-hmm.
like it's also instant liquidity if you need it.
Wow.
Yeah, yeah, I know, right?
Totally new market.
Yeah.
Okay. Okay, I guess now let's talk about the Upstart because a lot of my viewers they are in Upstart. Most of them don't know what Upstart does. I had a big trouble to understand what it does because I'm coming from the Western Europe culture where nobody is using the credit cards. So I guess can you start from the beginning? What is the credit score in North America and like what problem are the Upstart trying to solve?
Sure. So a credit score is a three-digit score issued by the Fair Isaac Corporation, known
Mm-hmm.
as FICO, and it uses, I'm not sure if it's five or six, somewhere around that range, those like a small amount of variables to
Mm-hmm.
give you a composite score that is reflective of your credit worthiness. In other words, your ability to repay a loan.
Mm-hmm.
And so somebody with a great credit score will probably have like 750 plus as their FICO score. Somebody with a not so great credit score might be in like the 500s, right? And so
Mm-hmm.
if you go to get a mortgage, if you go to get a loan, what these banks are looking at is your credit score. And that's based on, your credit score, that is based on how long have you been using credit, how many forms of credit do you have, sort of
Mm-hmm.
these traditional metrics that maybe are not entirely comprehensive as to how somebody is true, like how creditworthy they truly are. So think of it this way, right? An immigrant that comes to America, let's say they just got here, they're
Mm-hmm.
not going to have a credit history in
Yeah.
America. So their FICO score by nature already is going to be very, very low because there's no proof of concept of them taking out a loan and then paying it back. But
Mm-hmm.
what if that immigrant was coming over with excess savings and already had
Yeah.
a great job and maybe went to like Cambridge University and is really, really good? Well, that person is probably creditworthy. And so what Upstart does is instead of using five or six variables, they use thousands and thousands of
Mm-hmm.
variables to develop a more comprehensive profile and understanding of the borrower, their spending habits, their occupation, all to arrive at a more accurate estimate of somebody's ability to repay a loan. And so what they found is that education is actually more
Mm-hmm.
predictive of whether or not somebody can repay a loan rather than a FICO score. So like where somebody went to school, what they're studying, right? Like I always, this is not an example they give, but I always think like teachers, right? We know that teachers are probably financially stressed because they're not paid
Mm-hmm.
enough for the jobs that they do. But also, what do you know about a teacher, right? They're good with kids.
Yeah.
Most of the time, they're wholehearted people that have like roles in their community, right? So like that's valuable information as to how that person is going to prioritize whether or not they pay back a loan. So that's just one example. And then just going a little bit further, maybe on just preliminary, we can talk about it more about like what Upstart's machine learning and AI advantage edge is in there.
Mm-hmm.
Not only is getting credit one part of the puzzle, just getting a loan, but then also the price of that credit is equally as important. If nobody will offer you a loan, but I'll offer you right now a loan at 30%,
Mm-hmm.
well, am I really even doing it? I mean, that's like really high interest. So maybe
Yep.
I'm willing to offer you a loan, but it's only at a ridiculous price. And what sets that price? Well, it's FICO's preconceived notion of your risk based on
Mm-hmm.
a credit score. And what Upstart has found is that credit is mispriced across the entire system because the FICO score and the traditional credit metrics that used to evaluate somebody's ability to repay a loan are not
Mm-hmm.
comprehensive enough to accurately separate enough risk, meaning they allow too many defaults into the system, which means anybody who wants to get a loan has to pay more interest to
Yep.
subsidize the defaults that they're actually allowing. So Upstart uses AI and machine learning to lower default rates by
Mm-hmm.
improving the accuracy of their underwriting. And since they improve the accuracy of their underwriting, meaning more people pay back their loans, the aggregate rates on the platform drop because those who pay back their loans no longer have to subsidize those who don't pay back their loans because there aren't as many people not paying back their loans. And so you can
Mm-hmm.
think of pricing this way, in, like in this example, right? Let's say borrower A and borrower B are two people that are both looking to get a loan and they have the same credit score, right? And so they
Mm-hmm.
get priced at the same rate, say 7%.
Yep.
Well, what if borrower A is more likely to default in the first month of the loan than near the end of the loan? Whereas borrower B, upon looking at their bank statements, their jobs, and all
Mm-hmm.
that, is actually more likely to default in month 30 of
Okay.
36. Well, if borrower A's likelihood of default is much higher in the beginning of a loan, that warrants a higher interest rate simply because, well, you may miss out on the principal if they default earlier in the loan. But actually, what'll happen is even though these applicants have the same default risk over time,
Mm-hmm.
borrower A's default risk is front loaded and borrower B's is on the back end.
Mm-hmm.
So, what really should happen is that borrower A should get a higher rate because there's more inherent upfront risk, where
Mm-hmm.
borrower B should get a lower rate because the risk is near the end of the loan. But what
Mm-hmm.
happens is traditional FICO will price those borrowers the same, which means borrower A is underpaying for credit, and as such, borrower B has to overpay. And so, what
Mm-hmm.
Upstart will do in a very new feature that they just launched is they'll actually predict the likelihood of default in each loan for each individual month. And that
Mm-hmm.
allows them to price their loans differently. And when you give somebody the best rate and a very easy AI driven process, they convert more. And so that is a very long way, a long history of Upstart's history as a public company and how they grow. They grow by underwriting better and providing a better experience and giving access to credit to people that the traditional system, for however many reasons, may overlook.
Mm-hmm. Yeah, for a newcomer to North America like me, it was really confusing like how this credit system works because, for example, I have a friend, he just migrated from Ukraine to Vancouver. He has like few million of dollars of liquidity. And when he wanted to buy a car here, no bank gave him the loan because they said like you don't have a credit history. And he just shows them the bank statement like, hey, I have a few million in my bank account. Why can't you give me like $5,000 worth of the loan? Say, well, you don't have any history. You first have to build a history before
Mm-hmm.
we can give you something, even though your liquidity is so high. It was kind of under intuitive to me, like it doesn't make any sense. But in terms of the business model, let's clarify a few things. So let's say we are talking about the FICO, the Fire ISAC. Who pays who? Like, let's say me, Almas, I wanna buy a car. The FICO gives me a score and bank gives me the loan. So in this flow, am I paying to FICO? Am I paying to bank? Does bank pay to the FICO? Like how this flow works?
Yeah, so FICO is an IP, intellectual property licensing business. So they'll
Mm-hmm.
license their, I assume, tech and their score to all these banks and their database for all these banks and credit unions to make decisions on. So they'll
Mm-hmm.
actually look at that. That's how the banks will get FICO, and that's why FICO's margin. So if you look at FICO stock,
Mm-hmm.
and you're like, oh my God, this trades at a ridiculous valuation, which it does. That's because their margins are so high because they're just licensing out the FICO score to all these lenders who are going to use
Mm-hmm.
it to make a decision. And, Dave Gerard, the CEO of Upstart, just had a post on this the other day, and he's like, IP licensing businesses are great until
Mm-hmm.
they aren't. And that's because, these high margin businesses, if they face disruption, well, they're not going to be able to license out their IP, and then the business itself can collapse very quickly from there. So I think in the end, right, if Upstart's coming in and saying, yeah, like you banks and credit unions are using FICO, but hey,
Mm-hmm.
let's use Upstart's AI, which has a better ability to separate risk between borrowers, meaning they know which borrowers are going to pay back their loans at a greater clip.
Mm-hmm.
And they're able to approve more people because of this and provide a better experience. Well, naturally, what you'll see, I think, over time is these banks and credit unions start to move away from FICO and move more towards Upstart, which is not only more accurate but more inclusive. And so the first signs of this are starting to appear in the industry, because credit unions, which are the smaller fish, sometimes they're nonprofits. These credit unions in America, think of them as very, very small. They're focused more so on their members. So it's like a community bank, a regional bank, right? It's a smaller financial institution that cares about its community. These are the types of corporations that are using Upstart right now at a very high clip
Mm-hmm.
because they believe that it provides a better process and better rates and more approvals. And so it's easier to prove that to the smaller departments. They don't have as big of a glass ceiling as a large corporation. They're not
Mm-hmm.
as maybe backwards thinking as a large corporation. So that's where you're seeing a lot of the growth right now. But over time, I think it's very, very likely that banks will, even if they don't use Upstart, try and somehow get this technology for themselves once they see the results.
And is there a metric that Upstart management is sharing with the investor on what's the percentage of those loans went default versus what's the percentage of loans in FICO went default, just to make a comparison with which score is better, FICO or Upstart?
Yeah, sure. So, I wouldn't know the exact heuristic off my
Mm-hmm.
head, but on Upstart's website, there's a KPI that talks about. I, I don't want to try and repeat it because it might be wrong, but it's like, let's just say, for sake of example, it's like 50% more approvals at lower rates, which just
Mm-hmm.
means they're able to approve more people and experience the same default rate for
Mm-hmm.
that group of people than a traditional bank would be able to. And that's just
Mm-hmm.
because, all once again, because they're underwriting better by using more variables about the borrower and using more machine learning techniques to learn more about that borrower itself. So like if somebody went to Harvard, right?
Mm-hmm.
Well, we'll just when the model, Upstart's model, is underwriting that person for a loan, it's going to scan and talk to all the other data that's in the database and say, okay, well, let's look at all these borrowers that went to Harvard and maybe, they studied finance. Let's see
Mm-hmm.
what that impact has on the previous lending history of how they've paid back loans. Let's cross reference for all these other variables. Okay,
Mm-hmm.
now let's look at the macro. Like it's a talking system that uses all these different things to arrive at a better rate for the consumer, which is priced more fairly.
Mm-hmm. And in terms of the business model of Upstart on how they actually make money, so let's say there's a small credit union that decided to go with the Upstart score. Me, Almas, I wanna buy a car. I go to the credit union. They ask Upstart to give me information about the Almas. They give us some sort of a score, and then they give me a loan. And then let's say after a few months, I default on my car loan. I don't want to pay it back, and I return this car back to the small bank. What Upstart will make from this transaction? Will they just make money on bank asking Upstart what's the Alma score? And if I go default, will Upstart repay to this credit union?
Yeah, sure. So Upstart, it gets a lot of their revenue from fees.
Mm-hmm.
So meaning when you take out that loan, there probably will be a fee associated with that loan, which will
Mm-hmm.
go straight to Upstart. Now, most of the time, the credit union in this case that you're talking about is going
Mm-hmm.
to hold the auto loan. So, meaning if you default on that loan, it's not as much Upstart's problem in whole as it is the credit unions. Now, an auto loan is a secured loan, right? So they would take
Mm-hmm.
your car and then they'd
Yeah.
sell the car to get some of the principal back. But
Mm-hmm.
really, Upstart is not in traditional sense a lender. Like they don't hold the loans themselves. They will
Mm-hmm.
connect you, who's looking for the car, to the credit union, and
Mm-hmm.
then Upstart will also have their software embedded within the credit union so that
Mm-hmm.
they can go on and look, oh, Almas wants a loan for a car loan. Let's see this.
Mm-hmm.
Okay, well, this is the rate. Boom, approved. Now we're going to be the one to give you that loan. And so the
Mm-hmm.
credit union will then hold the loan on their books,
Yeah.
collect the interest payments on it, whereas Upstart will collect the immediate upfront fee for
Mm-hmm.
when the loan is originated. And I'm not sure exactly, but they may take a little. They may charge fees too for other things like the actual software and that they're providing to the credit union. But the bulk of the revenue comes from the fee of originating that loan. Now, sometimes when Upstart's launching right now new products, they'll hold the loans themselves meaning
Mm-hmm.
they'll get the interest payments, which comes up on the income statement as net interest income
Mm-hmm.
for that period. So there is some lending exposure there. And the reason the stock got crushed from 2021 to 2022, well, one reason is because as the lending environment deteriorated, they weren't able to sell as many loans as they wanted to. So instead
Mm-hmm.
of not originating the loans, they held those loans on their own books, which gave them more credit risk, which
Mm-hmm.
caused the market to re-rate the stock from a tech company into more of a lender, which caused, the share price to plunge. But a lot of those risks have since been taken out, and the
Mm-hmm.
business has changed very fundamentally from 2021. And we can talk about that later.
Mm-hmm. And in terms of those upfront fees, they are paid by the customer, right? Not by the credit union.
Yeah. Well,
Okay.
but I'm sure the credit union may pay to actually use Upstart software too
Mm-hmm.
to
And
get access to all those borrowers.
okay. And what are the margins on those fees for Upstart?
Sure. Well, yeah. I mean, that all ultimately depends, right? Like, what's the loan that we're
Mm-hmm.
approving? Is it an unsecured personal loan near the non-prime end of the spectrum, in which case the fee, is going to be a lot larger and the rate might be larger because there's more inherent risk? Or is it going to be, a super prime borrower who's got a 750 credit score and wants to borrow $10,000 for her daughter's first car or something like that, right? In which case the fee is going to be like a lot lower
Mm-hmm.
because of the risk profile. So that's why people or analysts are like, well, yeah, Upstart's going to grow, but they're going to grow at lower margins now because they're expanding into prime. But there's different margins on all those different products.
Mm-hmm.
Yeah.
Another thing I'm kind of curious. So let's say the Upstart takes the risk themselves, right? They are taking the loan and they are
hmm
sending money back to me to any borrower. So I know I don't remember the time, 2023, right? When the Upstart stock crashed. Was
hmm
it 2023?
2022.
2022, yeah.
Well,
So it
and through 2023.
okay. So it crashed, I don't remember, from like $300 to, as far as I remember, like $10. So all that fear came from investor because they were afraid of those loans in Upstart books, right?
Yeah. That's right.
Okay, and since then, I know the Upstart recovered nicely. Right now, it's I don't remember, like $52 stock. So what happened with those loans? Did they send those loans or sold those loans to the banks? Are they still holding them and showing to investors that the default rate for those loans are really low?
Sure. Yeah. So let me just take a stab at the 2021, 2022
Mm-hmm.
era. Starting with those loans, right? Most of them are off the books now.
Okay.
They've worked through a lot of that. But to really understand what happened, I guess we'll just start back in 2021, right?
Mm-hmm.
Upstarts goes public in December of 2020. Interest rates go to near zero post COVID. In fact, I just listened to a podcast with Sanjay, the chief financial officer,
Mm-hmm.
and it sounded like Upstart might like almost didn't survive initially during COVID. Like there were
Mm-hmm.
concerns about how they were going to survive, and they managed to pull through that. They go public. 2021 rates are near zero, and Upstart's business is essentially a one-trick pony, meaning the only product they have is an unsecured personal loan. Their entire capital base, meaning the people that are funding these loans, all of that capital is at will, meaning there's no definitive long term agreements. People can fund these loans as they please, and they can choose not to fund them as they please. So their
Mm-hmm.
revenue is very, very volatile. Um, and they had only their machine learning and AI secret sauce. They had only spent time on something called risk separation, which is
Mm-hmm.
just figuring out which borrowers are like mispriced. But they
Mm-hmm.
didn't spend a lot of time on calibration, which is understanding how the current macro environment will affect separation. And so that was another big change. So 2021, the business does great. There's a lot of capital. People are euphoric. Rates
Mm-hmm.
are near zero. And then the Fed starts to raise rates in 2022, and Upstart gets crushed. Number one, because as rates go, the Fed raises rates,
Mm-hmm.
lending rates go higher, which pushes more people out of the approval box. Number two, because Upstart's capital base was entirely at will, which meant
Mm-hmm.
as rates went up, lenders decided we're not going to be lending any more money. We're not going to
Mm-hmm.
fund these loans. So that really put a damper on Upstart's revenue. And then number three, because Upstart wanted to keep gathering more data for their models, and because they didn't want their revenue to totally collapse, they started originating loans and then holding them on their own balance sheet, giving them
Mm-hmm.
direct credit risk to the underlying credit, which the
Mm-hmm.
market had very little confidence in, and a very uncertain macro. So that all caused peak euphoria to peak depression.
Yep.
So now that's 2021 through 2022. Now we
Mm-hmm.
enter 2023. Upstart starts focusing on calibration, which is quantifying the impact that the macro is having on their risk separation. So they've been able to identify borrowers that pay back at greater rates or that are mispriced by the traditional system, but
Mm-hmm.
they weren't able yet to quantify the impact that the macro was going to have on that performance.
Mm-hmm.
So they launched the Upstart Macro Index in 2023. And that was their first sign of calibration. And that's when I was like, oh, okay, wow. Like they're fixing the number one problem that caused their business to really fall sharply in 2022. So that's what they started with in 2023. That was the first big key revelation. Now, if you
Mm-hmm.
fast forward quick to 2025, at AI Day, they showed that had they had those new calibration tools that they developed recently in 2023 to now, back in 2022, they would have avoided a vast majority of the defaults that they actually experienced. So
Mm-hmm.
they think in a future macro downturn, these new tools are going to really provide them with much more certainty and a greater grasp on their business. So that was the first change in 2023. Now we enter into 2024, right? And what starts changing is not only the fact that they've fixed calibration, but their models are really starting to get better. Because
Mm-hmm.
if you think of AI and how it learns, it's a very vertical slope.
Yep.
And the rate by which their machine learning models were learning and accelerating was continuing to increase. So they started releasing new models, M18, M19, M20, at
Mm-hmm.
faster rates than they ever have before. And that's also possible because their training data set was growing, which is unlocking new AI capabilities. So
Mm-hmm.
to recap, we saw calibration get fixed in 2023. We're moving into 2024, and the AI models are getting really, really sharp, much better, so much better that they would have avoided a lot of the defaults. And then the last piece of the puzzle,
Mm-hmm.
which came around, was a new funding structure. So now, well over half of Upstart's capital is in committed form, meaning long-term structured agreements. So, just perfect example of the benefits of this. During Liberation Day in April, when markets got really skittish,
Mm-hmm.
Sanjay, Upstart CFO, had even said himself that had they not had these long-term agreements, they would
Mm-hmm.
have got calls from lenders asking to pull back on their credit. So their funding base is more durable, their
Mm-hmm.
models are much better, and their AI capabilities are more comprehensive in all of what they look at. And then also
Mm-hmm.
there's another piece too, right, of more products. Now in 2021, right, we just had an unsecured personal loan, and that was really in the non-prime sector. Now we have that. We have prime personal loans, you have auto loans, you have HELOC loans. All of those have different cyclicality cycles, which provides more diversity to the underlying business. And
Mm-hmm.
we could go on about this forever. At AI Day, they talked about all these new different potential revenue models coming as well, including maybe Upstart subscriptions, where maybe you become an Upstart member and then you have
Mm-hmm.
access to credit on the go. So all of that to say, really, if you rewind and you look at where the company was just a few short years ago, they're in a drastically different place. They fixed a lot of holes in their business, and it's a
Mm-hmm.
very talented team that got caught up. A little flat-footed in 2021 and 2022, but they've recovered and they've acknowledged their mistakes, and I think they're set up really well for the next couple of years.
Mm-hmm. Yeah, before we start talking about the AI day that Upstart just had a few weeks ago, I wanted to talk a little bit about the competition. So in the beginning, as you mentioned, the Fire Isaac, the public company, all the banks, the major banks are using the three-digit number, the score from the FICO. So in this age of LLM, I know the Upstart started before the LLM era in 2021. So they were developing their AI models even before the LLM was a thing. So, but now when everyone can buy the API key from the OpenAI, use their LLM models, do you think the Fire Isaac can catch up with the what Upstart is doing?
No, I don't. So there's a couple. This a great question. A couple
Mm-hmm.
things on this. Upstart started using AI really, I think, in 2015 too. So
Mm-hmm.
long before the 2022 boom.
Mm-hmm.
But to understand what Upstart's doing, uh, they are spending 110% of their time, attention, and focus on
Mm-hmm.
repricing credit. It's not something that can be done very easily.
Mm-hmm.
So if somebody were to try and compete with them, it's going to require enormous amounts of time, and you have to have a very good, dedicated team focusing on it 24/7. So that barrier to entry itself
Mm-hmm.
already eliminates all the credit unions and all the small banks or whatever from trying to develop their own thing. They'll realize very quickly that the resources required to even get close to what Upstart has done are
Mm-hmm.
far too expensive than what they can actually do. So that would be my opinion on just the smaller banks. Now we start talking about big banks, right? They have all this data and they've got,
Mm-hmm.
let's say, unlimited money. The reason they can't do what Upstart has done is for a couple of reasons. Number one, same as earlier, they don't have the time or the regulatory ability
Mm-hmm.
or the desire to focus on pricing credit more fairly. In fact, Dave Gerard says often when he has talked to big bank executives, they don't want to lend to the non-prime sector. Like they just want to lend to people that they think are going to pay them back. Now,
Mm-hmm.
the other thing is the data set, right? They got big data sets, but data is not worth anything if it's not trained or if you can't decipher it. And so JP Morgan may have all this data that they've
Mm-hmm.
collected on borrowers that they've lent out to, but do you think they collected where they went to school, what their grades were, how their grades progressed
Mm-hmm.
through their semesters? Did they look at, XYZ, all these different variables that a borrower could have? Probably not. So then the first step is, well, you have to go back and get all that data and you have to try and back test
Mm-hmm.
how it resulted on the loans. And then you have to see, well, what are the implications of this for the future? So understanding the data set already is extremely complex. Whereas Upstart's data during that same time period in which a competitor may be trying to close the gap already is 10 years ahead in terms of how much it's learned and is
Mm-hmm.
continuing to accelerate and increase at a rate of change that is only increasing every single day while other legacy incumbents are playing catch up. So I think in
Mm-hmm.
short, like it wouldn't surprise me if competitors try and develop this because I think like Dave says, the technology will be so powerful in just a couple of years that people will undoubtedly understand if we can get more approvals at lower rates, like this is something we need to do. Smaller banks and credit unions will realize very quickly, I think, that it's way beyond their means to do something like this. And then I'm sure big banks will try and replicate it themselves. But I'm not necessarily convinced that they'll be able to do it. And if they are able to do it, I think by the time they get anywhere near what Upstart has spent every day for well over 10 years focusing on,
Mm-hmm.
Upstart will widen the competitive advantage and widen the gap. And oftentimes, when a new technology takes off, think LLMs, right? OpenAI, first to
Mm-hmm.
market, ChatGPT, they're first to market, so they've got all this brand recognition. Does that mean they're the best? Not necessarily, but
Mm-hmm.
that was a huge advantage. And so I think when we get into the where a world where I think we're going where look, credit is always available and you can always get it at the best rate, guaranteed with a very easy process that's completely automated. You don't have to talk to anybody and you can get it
Mm-hmm.
just right, tapping on your phone. I think that's going to be the Upstart app. And I think it'll be just so dominant that it'll be much, much easier for banks to just outsource and just
Mm-hmm.
use Upstart.
Yeah, I think one of the that is why I started investing in Upstart because I was really afraid of this thing called FICO that they will just take the market share from the Upstarts, they all mature. But then I remember that before in my life career, I've been working for the company called MasterCard, and in there I was developing a new product that we are going to sell to the banks. The product was nothing serious, just I would say 10 lines of code. But to ship this product, it took us half a year because you had to get the agreement from all the banks, you have to get the agreement from all the management. And I was thinking the FICA is as old as a MasterCard. So even if they want to go into the EI and start doing the same thing that Upstart does, it will take them a years just to start building
Yes.
like small feature while Upstart is like a more of a startup culture where everything is so dynamic and
Well,
they'll
and
be,
they're racing ahead.
yeah,
Yeah.
they're racing too much ahead.
Well, and also their Upstart is not a chartered bank. So
Mm-hmm.
they have all these regulations that they do not have to agree to
Mm-hmm.
or do not have to comply with. And the last thing I'll say on that, and this is a huge part of the thesis, is Upstart has been working with regulators since they were founded in 2012.
Mm-hmm.
So in the regulatory space with all different kinds of administrations, they're deeply embedded. Their models have been like overlooked very often by regulators. They have a dedicated team that speaks with regulators. Dave Gerard has testified in front of Congress, and he even
Mm-hmm.
said recently, like, Congress is no longer really skeptical that AI can better price credit. Like those
Mm-hmm.
sort of days are now behind us. We're moving into the next step of applying it in fair practice laws and things of that nature. So the regulatory scene is evolving, and just that alone for a bank. And then the
Mm-hmm.
bank also has to explain that to all of their customers and get it into all like it's so regulatory intense that they don't have the time really, or maybe even the resources, I think, to pursue it aggressively, which is why I'm confident most of them will probably outsource to Upstart.
Mm-hmm. Yep. Sounds good. Thank you. And yeah, I wanna listen more about the AI day that Upstart just had a few weeks ago. If you can share like what's interesting there that you found that maybe a retail investor need to know.
Yeah, great question. So I went to Upstart's AI Day in New York City a couple of weeks ago. It
Mm-hmm.
was really awesome. Super excited to have been invited, and it was a very small event. Think maybe like 40 people, something
Mm-hmm.
like that. And I'll say most of the people there were Upstart employees,
Mm-hmm.
leadership team members, and then there were a few, maybe like 10 or so, maybe a little bit more than that, analysts and me.
Mm-hmm.
And so my biggest takeaway would be for a retail investor, analysts cover a lot of companies. And I noticed very quickly that my mindset is, right, I'm here, I'm like, wow, like this is so friggin' cool. Like I'm at
Mm-hmm.
Upstart's AI event in New York City. Like Dave Gerard and the leadership team are right there. You know, all this Upstart color scheme and all this is around me. And I'm like, wow, it's really so fun to be here. And like, I'm really excited to listen more. For the analysts, believe it or not, it's like just part of their job. Like they're just
Yeah.
forced to go there and they have to listen. And so there wasn't a lot of enthusiasm among
Mm-hmm.
them. Not saying all of them, but certainly some of them. And
Yep.
then we get to the actual event, and it's in like a very small room, and there's like five tables, in a row, and a couple of seats. Leadership's in the front row, and then analysts and everybody else is in the back. And I'm sitting at a table with a couple of analysts, and there's a couple of analysts in front of me, analysts behind me. We get into the event, and I'm not going to say names because I don't want to get in trouble, but the
Mm-hmm.
analyst in front of me is not even paying attention while they're presenting, right? So
Mm-hmm.
he's half paying attention. He's on Bloomberg. The analyst next to him is refreshing quotes on Yahoo Finance, which is
Mm-hmm.
kind of like a little bit of a dinosaur thing. And they're not taking very many notes. And then the analyst that was sitting right next to me, when Paul Gu gets done describing his, technology part of the event, he's just like, yeah, I'll just have to listen to that again. I'm not really sure what he's saying and all this. And I'm like, well, but not to be that guy, but like as an analyst, it's kind of your job to understand what he's saying. And it's certainly complex, but like my impression was that they didn't have a very strong inherent understanding of what Upstart does. AI Day, for those who have been following Upstart really closely, had a lot of revelations of like seeing the AI in practice, but the core underlying message was a story that a lot of people were already like in tune with for retail investors. And so
Mm-hmm.
I think just connecting that back to, we talked a little bit earlier about the efficient market hypothesis, like for retail investors, for Upstart, right, we're spending a lot of time on this, collectively pooling our minds together. I know for a fact we have an information advantage over some of the analysts that were sitting next to me, which means if those are the analysts that are reporting this company
Mm-hmm.
to their firm, that firm does not have a correct understanding of what's currently going on in Upstart's business. That was a revelation that I think was very, very clear to me. The analysts were not spending a lot of attention, and also some of the questions they asked during the Q&A weren't all that great, I thought too. But that was my biggest takeaway is like
Mm-hmm.
retail, it's very easy to get caught up and think that we don't know anything, but I think we do. We may not know as much like overlooking about finance,
Mm-hmm.
certainly as those guys, the suits, right, at all those firms, but at a very micro level and understanding specific companies, certainly a possibility that we have a really large information advantage. But apart from that, man, the event was great. Leadership
Mm-hmm.
team is super cool, very nice, and they spent a lot of time following the event, answering questions. and they held closed door meetings with the analysts after the
Mm-hmm.
event, which resulted, I think, in like two upgrades the next day. But
Mm-hmm.
yeah, it was interesting.
Did they announce any new product or any new market they are entering?
Yeah, so I asked Dave during the Q&A, and
Mm-hmm.
they gave me a question which was really cool about purchase mortgage,
Mm-hmm.
and he said that purchase mortgage is coming, and that we should expect new products this year and probably new products every year. So it became clear to me once he answered that question that Upstart is trying to underwrite credit better for every single kind of credit. And then
Mm-hmm.
the most impressive thing, if they can get there, and I think it's going to take some time, is right now the personal loan model and like the auto loan model, those are two separate machine learning models.
Mm-hmm.
Eventually, they want to use one machine learning model that will underwrite credit for every single product. That will be extremely powerful.
Mm-hmm.
It'd be insane. I don't think it's anything like that has ever been done. So yeah, more products are coming.
Okay. So as of today, I just want to talk about the opportunity for new investors who are just entering Upstart. So I just made a small comparison. The Fair Isaac, because it's a public company, the market cap as of today is 43 billion, and for Upstart it's 5 billion. So would you say that the upper limit of where Upstart can go is from 5 billion to 43 billion and being the same as a FICO, or it can go beyond the FICO and being like 2, 3 times bigger?
Yeah, so I guess I should probably preface by saying like nothing that I'm saying today is financial advice,
Yeah,
right?
of
Like
course.
Upstart certainly has a lot of risks,
Hmm.
and just be aware of that. And I'm not trying to tell anybody to buy the stock, but
Hmm.
we're at, you asked where I think the stock is going, and I'm just gonna have to be honest. I think if Upstart does what I think it can do, which is underwriting, being the underwriting backbone for every form of credit and aggregating consumers onto a marketplace where banks and credit unions can pick and choose the loans they want to fund, and the borrower gets a seamless, very easy experience that's automated, instant funds. I think it could be one of the biggest winners of, like, I don't know, the next several decades if it does what I think it can do. So I think the market cap can be leaps and bounds ahead of FICO. You
Hmm.
have to think FICO is an IP licensing business that
Yeah.
licenses their score. Upstart has a more comprehensive and better way to do that very score.
Hmm.
They offer technology to banks and credit unions, as well as a marketplace aspect that connects borrowers and lenders, which is also different. And the returns that Upstart is able to provide and the way that they can grow is a lot faster than FICO is a hyperscale, small cap, right? Like tech company right now. So I think the market cap can probably exceed $100 billion if a hyper bullish scenario
Hmm.
plays out, in which case, from there, I'm not entirely sure where it can go. The business will be a lot different. But yeah, I think it can be way bigger than FICO. I think my benchmark has been, I think in 2021 at $400, it was maybe a $35 billion company.
Hmm.
I think fundamentally speaking, the company is positioned to be, or is positioned a lot better than they were then. Rates aren't going to go near zero, but I think the share price will probably exceed $400 again if they're able to turn this ship around, which I think they will. I thought pre-Liberation Day that it
Hmm.
was going to get to $150, by the end of this year, and
Hmm.
it was flying high in February near 100. So I still think 150 is possible, but it's going to be more difficult now with the tariffs and the Fed.
Hmm.
But that's my target for the next like year to 2 years is 150.
Okay. In your opinion, what are the biggest risks that investors need to be aware of Upstart? What can go wrong in
Yeah,
your
yeah.
thesis?
Great question. The biggest risk right now is the macro. Just
Hmm.
because uh so to go from at will capital, meaning it can come and go as they please, they're in long-term capital agreements. But
Hmm.
to do that, they're risk sharing on the performance of those agreements,
Hmm.
which gives them exposure, not in the traditional sense like a balance sheet, but it does tie them to the credit. Now, if the credit performs well, that can be an upside surprise and that can be a good thing. But
Hmm.
if the credit performs poor, that can be a headwind. And so I think the tune to which they're risk sharing is like 5% of the total agreement that they're signing. I
Hmm.
think I have that heuristic right from Sanjay's like conference a couple of days ago, but I'm not 100% sure. But the biggest risk for Upstart is that credit. and the macro faces a really high stress event again, as it did in 2022. And even though the business is positioned to handle that
Hmm.
with much greater resolve, they're still not 100% absolved from the macro. So any meaningful macro downturn will definitely impact them.
Hmm.
And, maybe more likely it's going to impact the stock probably a lot more just because people will get PTSD, if you will, fears from what happened in 2022. So it's still macro sensitive. The
Hmm.
point that I've tried to been make over the past couple of years is just not as macro sensitive as it has been in the past.
Hmm. Okay. Yeah, thank you. It was a really good information about the Upstart, and I hope all the listeners will now understand more like what Upstart actually does. Before we go, I wanna ask all the guests if they can share like the books you are reading, maybe the books you can recommend, or a TV series, anything outside of the investing world.
Yeah, a great question. I'm reading a book right now called
Hmm.
Crucial Conversations.
Okay,
I don't know if anybody's heard that, but essentially it's just like
first time
it's a
for me.
yeah, okay, yeah, what's a good book? You should read it. It's
Hmm.
like different ways to communicate with people and how to
Hmm.
understand different people's like different perspectives, where they're coming from, and how to prevent uh like I don't know, getting in like a feud with somebody over a disagreement. And the book really emphasizes how communication and the way that you present things and the way that you say
Hmm.
things is very, very important. And I think in finance, right, there's this preconceived idea that everybody's mean and we're all hot-headed and we're just trying to make money and we don't care about anything
Yeah.
else. And I think it shouldn't be that way. So a large focus of my branding strategy, if you will, has been really trying to just connect with people more on like a personal level and
Hmm.
explain things very candidly, so that people can interpret them as they'd like, and then
Hmm.
offer opinions on that too. And so I'm very fascinated by communication styles, how to learn to communicate with people better and understand different point of views. So Crucial Conversations is a really good book on that. Another one that I read that I would recommend to everybody who asks me for book recommendations,
Hmm.
um, is Richer, Wiser, Happier by William Green. I think
Hmm.
William Green is the author on that. So that's more of a popular book, but it talks a little bit about the disciplines of investing, but really it's about the mindset that you have to have when you're investing and how it unlocks freedom. And if you focus more on the freedom versus the money aspect, your psyche gets shifted a little bit. And so I don't know. I think it's just important for investors when you're looking at your portfolio every day, like I'm not honing in on the dollar amount of however
Hmm.
much my portfolio is up or down. Yes, I'll feel the emotions of, oh, it's up or down, but more so I just feel like vindicated and excited that my ideas are going well more than I am about, the dollar amount that I've actually made on something. And I've found that that makes me want to learn about investing more and I get a little bit detached from the money end of it, which is
Hmm.
certainly helpful. You know, April Liberation Day was
Yeah.
yeah, no, that was brutal. My portfolio has almost entirely recovered from that, which is funny because I remember feeling like shit on Liberation Day.
Yeah.
That was insane. Yeah.
My two biggest holdings, it's like okay, three biggest holdings. It's Hims, Cooper Standard, and Upstart. So
Yeah.
I was up 40% year to date before April, and in April I was down 20% year to date, and now
Yeah.
I'm back up to 40% again. It was
Yeah, that's like
brutal.
me.
Yeah.
Yeah. Yeah. That was really scary.
Yeah.
Now I'm happy because I didn't panic during that at all. In fact, I added the entire way down, which was
Hmm.
great. But like that's the thing too, like you have to really know what you own. Like I
Hmm.
feel like with everything that I own, I know it so well. And I know, at least I think I do, I know the bear arguments, I think better than the bears do. And it's so powerful. Like Upstart, I've been around since 2023 really heavily. That's when I started following it. And
Hmm.
all these different high short interest stock, right? 35% plus.
Yeah.
So people say a lot of negative things about it. And back in the day, meaning like 2 years ago, two and a half, I guess now,
Hmm.
those would really bug me because I didn't understand what this person was saying. I was trying to understand their point of view. And, some of the concerns were definitely legitimate. But now, fast forward to today, it's not uncommon for people to send me like a Seeking Alpha article, and it's like
Hmm.
rating downgrade on Upstart, And so I'm like, all right. So I spend, 5 minutes reading it. I'm like, okay, this person, they may think they know what they're talking about, but my understanding of the business and I've already is different than that. And everything that they're saying to express caution on is something that internally I've already looked at, I've already thought about, and I've already said to myself, this may be a risk or maybe this isn't a risk, but I'm comfortable with that already. So, like, there's nothing that catches me by surprise anymore with a lot of these companies. And so that helps keep me more, grounded and resilient and really avoids a lot of panic when things don't go well or when the
Yeah,
market falls.
totally agree. Okay, yeah. Thank you, Henry, for joining the podcast, being the first guest. I was super nervous. Thank you for spending your weekends on this small podcast. Anything you wanna say before we go?
Well, thank you for having me. It was a lot of fun. Maybe I have to come back on, do it again. But just
Totally.
yeah, yeah, no, it's great. I don't know if I have anything to say just for the listeners, I guess, right? Like retail investing. Let's go retail. Like we
Yeah.
can do it. These institutional guys, they've got fancy cars, big suits, and not all of them are mean, but like we retail belongs on Wall Street. Don't let anybody tell you different. And think about the biggest winners over the past couple of years. Hims, Palantir, Tesla. What did Wall Street say about them, right? They said they
Mm-hmm.
were like trash. So have some confidence, man. Like not you specifically, but like retail. Like let's have some
Yeah.
confidence. I see all these retail investors thinking like, yeah, well, we're just retail. Like let's flip that around. Like retail, let's go. So that's my message. Pick it
Great
up.
message. Yeah.
Yeah.
Okay. Thank you, everyone. Thank you, everyone who listened. And I will see you next time.